Mickey, I think you want to,
I should stop sharing maybe.
Yeah.
Okay. No, you probably could share, Eric.
Are you guys able to see that yet?
not yet.
Okay. Let me go ahead and click share.
There we go.
All right, great. So I'm just pulling up my slides here. So thank you again. My name is Eric Smith. I work with First Community Mortgage. I've been in the mortgage business for this will be my 17th year. Currently, we are in unprecedented times with interest rates, home values skyrocketing. And so I just wanted to talk a little bit today about home equity. Currently, it's at an all-time high. Homeowners have never had more equity than they do now, ever on record. But we're also faced with rising interest rates. They seem to be changing by the day. So I pulled some numbers and these are from a report by Black Knight, which is a national real estate research firm that many lenders across the U.S., banks and mortgage companies use. And this talks about the home equity by the numbers. So currently the average mortgage holder, and this is in the U.S., has about $185,000 of equity to tap, which is the amount that they can access while still having 20% equity in the home. Homeowner equity across the U.S. stands at an aggregate of 9.9 trillion, according to Black Knight, and that comes after a 35% gain in 2021 alone. So equity across the board, on average, went up by a 35% factor last year alone. That equated to $2.6 trillion of equity across the United States. And that happens to be the largest annual increase on record, beating the previous year, which was a $1.1 trillion increase to equity in 2020. In third quarter alone, we don't have fourth quarter or first quarter numbers yet, but in the third quarter alone of last year, borrowers extracted $70 billion from their home through cash out refinances. And again, cash out refinances accounted for 54% of all refinances, which was the highest quarterly rate in 14 years. Now, currently, with the rising interest rates, cash out refinances are accounting for about 90% of all refinances. All the rate term refinances, where someone's just refinancing their existing loan to get a lower payment or a different term, that volume is way down due to the rapid rise of interest rates over the last 6 months. So currently about 90% of all refinances that us lenders are doing are strictly cash out refinances. So just want to highlight some of the uses for equity and how it pertains to qualifying for another property or several other properties. So one of the first and most common uses of equity is consumers and investors will take that equity out of a property and they will pay down debt that they have on their credit report. That could be car payments, credit cards, personal loans, and that would then lower their debt to income ratio when trying to qualify to buy a secondary or subsequent properties. Another use for the taking equity out of your property would be to finance a renovation or repair to an existing property that you own. So you can list that for future sale and get top market value for that. Also to use for the finance and purchase of and renovation, of a fix and flip. So a lot of clients are taking that equity out, finding that needle in the haystack, that property that maybe needs some TLC, and using that to purchase the property, renovate the property, and again market it for resale in a short amount of time, again to maximize that market value that they can get for that property. I have a lot of clients, and this is common across the U.S., Some clients have enough equity to take that equity and pay for 100% cash deal on another property, or sometimes 2 or 3 properties, depending on that equity position. So in that case, no other financing is needed. You're taking that equity out and simply purchasing another property. We've seen that more common over the last 12 months than in my time of doing this. And the second most common is going to be the use of the equity for down payment and closing costs for an additional purchase of a property that you're going to be financing, or multiple properties. So, for example, I've seen multiple times where clients may have, we'll just throw this number out there, 200,000 in equity that they're able to extract from an existing property. And they'll take that and they'll divide that maybe into 4s and use a quarter of that to purchase 4 different properties. They'll use a quarter of that for the down payment, and they'll use a quarter of that for another down payment, etc., as well as closing costs. And then they'll have loans on those 4 properties. Now, the down payment requirement is going to be dependent upon the loan program. If you are going to finance another property, and I'm going to discuss some of those different options here on the next page. I will say this, again, we're in uncharted territory with the rising rates, home values. So the guidelines that are currently set forth, they seem to be pretty fluid. The down payments, the lending programs that are available, sometimes they're available for a period of time and then they go away, and then they come back. We saw that a lot during the pandemic. So the banks are very keen, and the lenders and the risk managers are very keen to what's happening in the market. I know there's a lot of talk recently about a potential recession in the future. And so that's why I say that the guidelines and programs are fluid. They may, compared to today, require an extra few percent down 6 months from now, or they can remove a program altogether. We normally don't see a program get removed. It's normally that the requirements change. They just tighten the credit standards if the economy or they believe that there's a higher risk. So a couple of ways to access home equity. So currently, the most common is going to be a HELOC or home equity loan. And the reason for that being is, previous to now, a cash out refinance on your home was primarily the number one and the lowest interest rate, and the number one option to take that equity out of your home. Well, with rising interest rates, where they've gone in the last 6 months, if you have an existing first mortgage on your property, and that might be at 2.875 or 3.5 or 4.5 even, and now you do a refinance cash out, that first lien gets paid off, and then added to that loan is going to be that equity that you're taking out. Well, based on current interest rates, sometimes that doesn't make the most financial sense. Oftentimes, currently, it does not, because you already have that great low rate on that first mortgage, and we don't want to touch that. We don't want to bother that at all. So these 2 options, a HELOC or home equity loan, are very, very good options when trying to take equity out of your home. So the way a HELOC works is that is a home equity line of credit. And it's just as it says, it's a line of credit, and you only use it as you need it, and you only pay for what you've borrowed. So you can take out a home equity line of credit for $100,000, and let's say you only need $50,000 to purchase another property or to pay off some debt. You only pay on that $50,000. The other $50,000 is available on your line of credit for you to use at any point in time, but you don't pay any interest on that until you actually use it. All right. And home equity lines of credit, traditionally, now every bank's a little bit different, but they're pretty much standard in terms of the draw period. So you usually, when you take out a home equity line of credit, you have a 10-year draw period. that means that that line of credit is available to you for use for 10 years. At the end of 10 years, you have the option to refinance that and renew that equity line of credit. And then you have another 10-year period, or whatever balance you have outstanding at the end of year 10, your lender's going to tell you, okay, we need to turn this into a fixed set interest rate installment loan. And then you'll choose with your lender anywhere from a repayment period from 1 to 30 years. And then you'll have a fixed rate and a fixed monthly payment, and it's amortized over that loan term that you chose. Again, anywhere from 1 to 30 years. Now, home equity lines of credit, they are tied to prime rate. So prime rate is, again, we're in a rising rate environment. So as the prime rate adjusts, that home equity line of credit will adjust. So if the prime rate increases 0.25%, the interest rate on your home equity line of credit will also increase 0.25%. If they drop prime rate, which we don't see anytime soon, it's been at record lows for a decade now, your interest rate would also drop in accordance with whatever that prime rate does. And usually it's not, overnight where it's going to jump up 3% or 2%. The Federal Reserve meets tomorrow. They're expected to adjust the federal funds rate. That is different than the prime rate. The prime rate, the bank set, but that does have some correlation. So after tomorrow's rate increase, home equity lines of credit should have some sort of rate increase in the week or weeks to follow. The second option is that home equity loan. So that's where you tell your lender, hey, I want that whole 100,000 in a lump sum. You'll get those funds dispersed immediately to you. And then again, you're going to have a fixed rate, and then you're going to choose a loan term 1 to 30 years. The shorter the loan term you choose, the better that interest rate will be. And every bank's a little bit different. So it behooves you to shop around when you're talking about a home equity line of credit or home equity loan. Every bank has different rates on that. And again, as I mentioned, it's a great option for the current interest rate environment. More and more clients are using this to tap into equity than doing a refinance cash out. Now, if you don't have a lien, if you don't have any mortgage balance on a property that you own free and clear, then a refinance cash out, which I'll get down to here in the next bullet point, will be probably a better option. Also, you will find some limitations with the home equity line of credit and home equity loan, is that if the property that you own is a second home or an investment property, so if it's not your primary, some lenders won't touch anything besides a primary home in terms of giving you an equity line of credit or home equity loan. We've seen a really big shift of this over the last decade, and even more so when the pandemic hit. Banks tightened up around which properties they'll offer the home equity line of credit or home equity loans on. So for a standard refinance cash out, most clients, 67%, will fall under the conventional conforming loan. So these loans are insured and backed by Fannie Mae and Freddie Mac. Those are the two conventional housing agencies here in the US. And they have requirements that all lenders must meet. And so the first one being that if you have a primary residence, they will allow you to have when you're taking equity out, they'll allow you to have a max loan to value of 80% of that appraised value. If it's an investment property or second home, then they cap that now at 75% of the appraised value. And the way that's calculated is I broke that down. It's going to be whatever that home appraises for times either 80% if it's a primary residence, or 75 if it's a second home or investment property, minus any existing loan balance you have. So if you already have a mortgage on there, that's deducted from there. The remaining amount is the amount of equity that you're able to take out. Now, a conventional loan is also going to have Credit score requirements, 620 is currently the standard minimum requirement for both Fannie Mae and Freddie Mac. And they also have other guidelines, such as how your income's calculated, mention the appraisal, assets. If you own multiple properties, both loan agencies require, based on the overall risk of the file, they will require you to have additional reserves for any other properties you have. And a reserve is equal to 1 month's mortgage payment. So, and it's different for everybody. So as a lender, when we have your application, we run it through an automated underwriting program through Fannie and Freddie Mac. They each have one. And it will tell us, based on your application, your credit score, your overall risk, and your other properties you own, how many months reserves you may have. Sometimes it's 1 month. Sometimes I've seen 6 months. So that can play a part on whether you get approved or not for a refinance cash out doing a conventional conforming loan. Not to go backwards, but on the home equity and home equity loan, the banks, and again, that's done by all your regional banks, your national banks, your credit unions. They all offer home equity loans and lines of credit. Your credit unions where you live are going to be much more lenient. Their interest rates are going to be better, and they will also allow you to borrow more than some of your bigger national banks and your regional banks. So for those that don't qualify for either a home equity line of credit or a home equity loan based on the bank's guidelines, or the conventional conforming loan, there are a new product set that has hit the market in recent years, and that is the non-QM loan. So the non-QM, QM stands for qualified mortgage. When the financial crisis hit a little over a decade ago, the government stepped in and changed the game for all lenders. And they came up with these requirements that a lender must meet on every single loan to make sure that the customer can repay that loan. Or otherwise, if the loan goes south, the lender can be forced to buy that loan back and the lender takes that loss. And so they called that a qualified mortgage. And so that's probably 78% of all mortgages. But private equity firms, hedge funds noticed that there was a large segment still of customers that didn't meet those guidelines, whether it was from your community bank for the home equity lines of credit or the home equity loans, or the guidelines that Fannie Mae and Freddie Mac have set forth. So that's where the non-QM products started. And there's a bunch of them. I have one more slide after this, and I've highlighted a couple of the most common, but there's probably, up to 14 different ones, pretty much to fit everybody's scenario. And everybody does have a unique situation. So the first one, which is the most common, and this is the most common for investors, is the DSCR loan. So that is the debt service coverage ratio loan program. So basically, in a nutshell, the only qualifier for that, and there are some others, but the main one that most of these private lenders that we've teamed up with, as well as other lenders have teamed up with, the primary thing that they look for on these programs, these are for investment properties only. So you must be buying an investment property to rent out, or have an investment property that's currently rented out. An appraisal gets done on that property, and that independent appraiser will do what's called a rent schedule. And basically that will determine what the fair market rent is for that property in that location. So whatever that fair market rent that appraiser determines based on the rent schedule, as long as that covers what the mortgage payment's going to be for that property. So your principal and interest, your taxes and insurance, and if you have any HOA dues, that total, as long as that fair market rent will cover that, that's all you need to qualify. It's the easiest program, and this is the fastest growing non-QM loan program currently in the US. And it's really exploded over the last 6 months, but it's been around for a couple years, and it's now gaining traction. Now, these interest rates on a non-QM loan are going to be higher than a conventional loan. All right, and that's because it doesn't have those layers of risk assessment in verifying income, credit, and assets like a conventional loan does. So these since they don't ask for those things, they carry a higher interest rate to offset the risk to that end lender. They also may have some more restrictive loan to value. So for the average is about 70% max loan to value when you're taking cash out of a property, and that's for an investment property. Some, yes.
This works for the non-resident, non-US resident investors as well.
So that's going to be on the next slide.
Okay.
Very similar. Yes, exactly
Okay.
correct. Yes. Very similar situation. There's just a few caveats to that one, which I'll get to on the next slide. Yeah, great question. So this one also, these non-QM loan programs, they can also be used to purchase an investment property. And currently, just closed one yesterday, the down payment requirement is only 15%. Now, on a conventional loan, if you're doing an investment property, that requires 25%. So it's a great tool to keep money in your pocket, potentially for an additional property purchase. Or if you simply don't meet or don't want to turn in all the documents that's needed for a conventional conforming loan, these non-QM loan products are really a great product. So I'll go on to this page here. Second program is the bank statement program. So again, this is a non-QM loan, and this is primarily for self-employed borrowers who itemize or deduct a lot of things on their taxes. As you know, if you're self-employed, the IRS tax code allows you as a business owner to write off quite a few things. Well, the problem is for us lenders, if we're trying to do a conforming conventional loan, Fannie Mae and Freddie Mac say, hey, you must go by the net income. Now, there are some expenses we're allowed to add back in, but oftentimes that'll blow up the deal right there, and we can't offer a conventional program. Again, with one of these non-QM programs, they'll say, hey, let's not even look at tax returns. Send us your 12 months bank statements for your business and your personal, and then they will come up with, there's a formula where they will use the deposits going in and an average monthly balance that's on your statements to come up with an income stream. So again, really easy program, not very much to it. Credit scores and that really don't play a part. Tax returns and income aren't even looked at. And then as Kiko asked about the foreign national program. So this one, this allows for the refinance of properties. It also allows for the purchase of properties for foreign nationals. And the only really difference is this one. Now, this one is like the DSCR program, where it's going to depend on that fair market rent. Is it covering the mortgage payment? That's really all they're concerned with. But for the foreign nationals, it is going to require a letter of good standing with the bank in which they bank at overseas. And those are capped to a maximum 65% loan to value when you're taking equity out. Purchases, I think yesterday, I was just checking because they just updated with a few of the lenders, and I think we can do 75% on a purchase of an investment property, so 25% down. So again, that's going to require a letter of good standing with the bank, and then we have to show 2 months bank statements that those assets are available. Unless you're taking equity out of a property, then the bank statements are not needed. So again, there are multiple programs. The non-QM segment is projected and is currently the fastest growing loan segment out there. And like I said, I think there's a total of 14 different ones that we can tweak and make work, depending on what your goal and what the property type and what you're trying to buy. It does work for single family residences, multifamily residences, also works for condos. Multifamily, the most that we can do on any loan product without it being a commercial loan is going to be up to a 4-unit property. But anything 4 units and under, any of the loan programs I mentioned, including conventional loans, would be allowed. So if you have questions, please reach out to Akiko and team. My contact information is there. I recently moved. I'm born and raised in Ohio, so very familiar with that. I recently moved just a couple months ago to Alabama, but I still have an office in Columbus, Ohio. So feel free to call or email, text me. I work 7 days a week, and if anyone wants to dive deeper in any of these loan programs to see if it's a right fit for you, or if you just want to know what the interest rate would be, please don't hesitate to reach out. Thank you.
Perfect. Thank you, Eric, for that informative presentation. I know we do have